All right, year two. First of all, congratulations on completing your projects and getting through that. And now you get to be in year two. So in year two is where we go from talking about ratios, talking about balance sheet and income statement structures to talking about asset liability management. And ALM is the acronym that we use to describe that. And asset liability management is where we go from seeing the balance sheet, seeing the income statement, and now being able to take that one step further and analyze the risk that is inherent in both the balance sheet and the income statement. And the primary risk that we evaluate is a changing interest rate environment. So changing external rates. When external rates change, what does that do to us inside the credit union? So when we look at ALM reports, and I would encourage you between now and the time that you come back to UGA to go find the ALM reports inside your credit union. You can bring them if you want to, but just look at them, see if they make sense, see what questions come to mind as we're going along. So here on the first screen, you got my email and my cell phone. Most of you have those and have used those. So feel free if you got questions before you come, let me know. Shoot me a question, give me a call, and we'll go from there. So when we talk about ALM, you'll hear this described quite a bit. You'll hear this term of rate shocks. So rate shocks are when interest rates go up or go down by a large amount. So usually, when I say a large amount, usually we're talking about 300 basis points up or down. And the interesting thing for me is that for the examiners, for the federal examiners from the NCUA and state examiners, they want to focus on a rising rate environment. And so, for a lot of credit unions, our ALM reports speak to that plus 300 basis point environment, that rapidly rising, increasing environment. But then there's also the downside, the decreasing rate environments. And I think that for us in credit unions, I think that poses a bigger risk for a lot of us than a rising rate environment. So as we're going along, we'll definitely talk about why that is and what those rate shocks can do. But they are trying to measure this acronym of IRR. IRR is interest rate risk. Interest rate risk. And that's when external interest rates change. How's that going to impact us? Because no credit union gets to operate in a vacuum. You could be the largest credit union in the world. You could be the smallest credit union in your community. Nobody is immune from changes in external interest rates, because when those interest rates change, that affects our members and that affects our member behavior. And at the end of the day, when we talk about asset liability management inside of a credit union, that's really what we're talking about. Do we have the ability to understand member behavior? What is it that our members really want from us? And then do we have the ability as a credit union to give that to them? Okay, so always be thinking about ALM in those sorts of terms from a high level, and then we'll get into the different types of risk positions that we have. So here's some of the considerations as it relates to ALM. You want to always look at if we're extending maturities, whether those extended maturities are on loans or investments. We want to make sure that we understand if we do those extended maturities, how might that impact us? Now, that typically comes back to a concept that's called the average life of a loan or the average life of an investment. The average life doesn't take into consideration, it doesn't matter what the term is. What matters is how long is the instrument really going to be on our books. That's what the average life is. And so when we extend maturities, are we extending the average life? So that would be one thing that we would want to evaluate from a loan perspective. From an investment perspective, if we're going to buy 10-year investments or investments that are going to mature in 10 years, how's that going to impact us if we have to wait 10 years for that investment to mature, for that to come back to us? So those are just some of the things to think about as it relates to extending maturities, using the ALM systems that our credit unions have, whether they be in-house systems that we run ourselves or outsource systems that a third party runs for us. We have to be better. We have to get used to being able to dive into those reports and see what are those risk positions that I'm really trying to evaluate. The term ALM, it can come down to a multitude of things to talk about, but here's a couple of really high level definitions that I think helps bring back to us what is it that asset liability management really means. When we have loans coming onto our books, loans going off our books, and when I say our books, I mean the balance sheet, deposits coming onto our balance sheet, deposits going off our balance sheet. Their balance sheet management is a huge undertaking. And at the end of the day, the reason that we want to try to manage both sides of the balance sheet, both the asset side and the liability side, is because we want to generate consistent returns. And the consistent returns, as you probably remember from the ratios, the consistent returns come out from ROA, return on assets, because that's net income over average assets. So I would like for a consistent return for my ROA to always be 75 basis points or 100 basis points, whatever the number is. Okay, so I want to generate consistent returns, and the primary way that I'm going to have to do that is the second bullet point that I have up here. We're going to try to manage risks, because if I'm going to make money, I have to take on risks at some point, some instance. I have to take on risk if I want to generate return. In the investment world, that's referred to as the risk versus return trade-off. As the risk goes up, so should the return. But even if the return, goes up, I still want it to be consistent. I want to have an understanding as to what is it that number is going to be for us. And we've probably talked about this before, but I just want to reiterate this again. Risk is a perception. I mean, it could be that a person or a credit union, an entity, finds risk in doing something that another person or a credit union or entity doesn't see the same risk there. And so risk being a perception means that there could be differences of opinion as to what's risky and what's not. So at the end of the day, if something has risk in it, which it always does, then we can just come back to, well, what's the return on it? How about that? Instead of talking about, is this more risky than something else? We can just look at, well, what's the return? Sort of like subprime lending. If I'm gonna lend to an A credit and I'm gonna lend to a D credit, maybe my underwriting standards, maybe my loan officers, maybe they don't perceive a lot of risk difference between the A credit and the D credit, especially if they know them. But at the end of the day, we use that credit score to determine what their return is, their rate is, what's the return going to be to us. And so those are just some of the things that we can start to delve into as it relates to ALM. We want to generate consistent returns, and we're going to do that by learning how to manage risk, because we're never going to be able to eliminate it. Okay. When we talk about an ALM strategy, just from a really high level, 10,000 feet, this is how we go about asset liability management inside of a credit union. So the first thing that we're going to do, the first bullet point, is I'm going to set the performance targets. So that could be return on assets. That could be we want our net worth ratio to be at a certain point. That could be, we want loan growth to be X or Y. Whatever it is, here are the performance targets. Okay, so that's where we want to be. For a lot of credit unions, that's usually found in the budget. And once we have those numbers, once we have the performance targets, then we move on to, well, how much risk are we willing to take on to hit those performance targets? So it could be that we're willing to take on a lot of risk. Maybe we feel that we don't want to take on much risk. The place where you're going to find how much risk your credit union is willing to take on is inside of your ALM policies. So between now and the time that you show up for Circus year 2, see if you can find the ALM policy for your credit union and read it. See if it makes sense. See if somewhere in there you can identify how much risk we're willing to take on inside of the credit union. And the risk is probably going to be, how much of a change in net income are we willing to accept? How much of a change in capital are we willing to accept when we have extreme changes in the rate environment? So that's where the risk parameters come into play. And then we assess, how is our forecast doing, or how's our current balance sheet doing when compared to those risk parameters? That is where we're running the ALM systems, the asset liability management models, because out of those models comes the output to tell us how are we doing compared to those parameters that we have. And then if we're inside the parameters, that's good. Maybe we can achieve those performance targets. We haven't taken on more risk than we said we're comfortable doing, so we're fine. But if we're outside of those parameters, so maybe our net economic value numbers are too high. In other words, the volatility in our capital is too much. We're outside of our parameters. Well, now I would have to be down here on the 4th bullet point. I need to develop a strategy that's going to help me get back inside of those parameters. And somewhere in your ALM policy, if you get a chance to read it before you come, my guess is that your credit union probably has a mechanism that says, if we're outside of the parameters, here's what's going to happen. So at my credit union that I work at, we can be outside of parameters for 2 consecutive quarters. And if we're still outside of parameters after the 2nd quarter, then there has to be a written plan delivered to the board of directors that says, here's how we're going to get back inside of those parameters. So look for verbiage like that. But that's how we go through the process. Where do we want to go? How much risk are we willing to take on to get there? Let's evaluate that risk. Are we inside or outside of our own parameters? And then if we're outside of the parameters, what do we need to do to get back inside? What do we need to do to decrease our risk profile? And just know that when we're talking about asset liability management, if you're outside of parameters, it might not be something that you can change anytime soon. Maybe your credit union bought a lot of investments that had a lot of interest rate, they have a lot of interest rate risk in them, especially if interest rates have gone up dramatically. So it could be that the strategy is just to not buy any more investments until those mature or pay down or whatever the case may be, even though we realize that's going to take 4 years, 5 years, maybe it's 6 years. Okay, so now we got to manage that piece of it. So that's kind of the process. And again, from a really high level, those are general bullet points, but that's really how you go about managing risk. Okay, so like I mentioned, when you look at your policies, if you get a chance to do that, this is where you might find verbiage that maybe it looks like this. The credit union's management feels that a decrease in net income that exceeds 50% or more in adverse rate environments is not something that we're willing to tolerate. So if net income is what we are evaluating, that means we're going to be looking at a net income simulation, NIS. If I have a policy that talks about a decrease in capital, That's where we're then going to look at net economic value, NEV. So net income simulations evaluate the risk to the income statement. NEV evaluates the risk to the balance sheet. Okay, so if you get a chance to read your ALM policy, that's what you're looking for as far as appropriate limits are concerned. And just know that for each credit union, it's going to be specific as to how much they're willing to tolerate. Now, I realize, for a lot of us in credit unions, we just get a policy from somebody else and replace the name of their credit union with our credit union's name, and then we present that as our policy. But when you really get into it, there's going to have to be a rationale as to why did we pick that particular number. Okay, so credit union specific is the limits. And some of it's going to come down to the comfort level. But just know that if you're going to look to the regulators to offer insights on what should it say, what should it be, you're not going to find a lot of input from the regulators, because what their job is to see what your policy says, and then where are you at in relationship to your own policy. So just know that when you're looking at limits, those are going to be some of the things that'll go into it. So before we get into net income simulations and net economic value, one of the tools that I think has a lot of value, especially if you're new to ALM, if you're new to looking at asset liability management, is a spread report. Now, a spread report tends not to be one that's found a lot inside of ALCO meetings. ALCO, ALCO, the Asset Liability Management Committee. This tends to be the committee that meets inside of the credit union, where they're talking about balance sheet management and those sorts of things. So you tend not to find a spread report there, but if you can get your hands on it, a spread report is a great way to start understanding the relationship between the balance sheet and the income statement. And the reason is because it turns everything into a ratio. And coming out of year one, you would be very comfortable looking at the ratios. So for example, when you see this spread report here, so look up here at the line that says total earning assets. So that right there, that's the yield on assets that you calculated for ratio number one, right? And then I've got my yield on assets, and then down here, I've got my cost of funds. My cost of funds was ratio number two, right? How much am I paying on deposits and on borrowings? And then I start to work my way down. So here's how much I'm making in non-interest income. Here's how much I'm paying in non-interest operating expenses. Remember, ratio number four is where you netted out these two numbers. Okay, so here they're just broken out on individual line items. And so at the end of the day, a spread report, the bottom of a spread report, where I'm taking what's the net income for the year, what it tells you is what my ROA is. But it tells me what the ROA is based on all of the different parts of it. So we can see, well, what generates the most money for us at the credit union? Is it loans? Is it investments? How much is it? Those sorts. I mean, as you can see in this example up here on the screen, I mean, look at the yield on the loans compared to the yield on investments. It's a lot more money, but which one's bigger, the loan portfolio or the investment portfolio? The answer, the investment portfolio, right? So even though I can make more money on loans, for some reason inside the credit union, we're buying investments. So why is that? But then also, what type of investments are we buying? And then that's going to work its way down to the bottom line, the ROA numbers. So we can see on a spread report all the different numbers that we calculated, because we're familiar with it, and it shows us, well, what are the areas that we need to focus on? Okay, so that's one of the reasons that I love a spread report, because it brings me back to the relationship to between the balance sheet and the income statement, and that's obviously very helpful to us. So see if you can find that inside of your credit union, and then take a look at it before you come for year two, and then we get into the actual ALM reports, the actual asset liability management reports. So why did ALM, or interest rate risk, become such a big deal for us in credit unions? And there was a letter published in 1999. When you see letter 99-CU-12, that's an NCUA letter, and the first two digits are always the year that it was posted. So in 1999, the NCUA issued a letter to credit unions that said that there's three different types of risks: interest rate risk, credit risk, liquidity risk. And then there's the three tools that you can use to evaluate those risks. There's a gap report, there's a net income simulation, and there's net economic value. Now, before this letter, the two primary tools that we used to evaluate interest rate risk was a gap report and a net income simulation. So a gap report is a tool that we would use to evaluate the risk in the balance sheet. Net income simulation is a tool that we use to evaluate the exposure of the income statement. Now we use net economic value as the tool to evaluate the risk in the balance sheet. So a gap report is not used very much at all anymore. So for us in credit unions, we look at net income simulations and net economic value. The reason this letter came out is because it was in the late 90s that credit unions started to hold first mortgages on their balance sheet. Up until they started doing that, the primary loan that credit unions made was car loans. So then they started to hold a lot of real estate loans. So that's where the NCUA said, well, when you're doing that, you need to move from using a gap report, which is a very basic static tool, to using a net economic value report, which is a lot more dynamic in what it can measure. So when you look at your ALM policies, you're probably going to find these three risks are listed in that policy, and when you see them in there, you just want to make sure that you can understand, well, what is the credit union doing to measure credit risk, as an example, and when we talk about risks that are out there, so interest rate risk. Interest rate risk simply means that when interest rates go up, the instrument that I have on my books, think of a 30-year fixed rate mortgage. So somebody that's a homeowner, when interest rates go up, that's less of an incentive for them to prepay their mortgage. Now, prepayments can come in two forms. One, somebody might just send me more than their contractual payment. So if the mortgage payment is $500 and they send me $600, that $100 is a prepayment to the credit union. So that's the first type of prepayments. The second type of prepayments is when the loan's paid off early. So if they refinance their mortgage, if they sell the home, either one of those two things is going to cause me at the credit union to get money back on that loan. So that could be another form of prepayment. Well, as interest rates go up, there's less of a chance that people are going to prepay their home loans. So therefore, I have to wait longer to get that cash back to the credit union. And so whenever we think about a risk, if there's a risk, there has to be an outcome to it. What's going to happen if we don't manage interest rate risk? The answer to that is liquidity risk. So it could be that if I take on a lot of interest rate risk, maybe I'm not getting back enough cash into the institution to manage my day-to-day operations. And so that liquidity risk usually comes in to be tied to interest rate risk. when we think about credit risk, what is credit risk? Credit risk is we're making loans to people that maybe they don't have the propensity to prepay the loan. So the outcome to credit risk is charge-offs. And when we have to charge loans off, that can be an expense to us to increase our allowance for loan loss. Okay, so just different things to think about, but those risks. When you look at your ALM policy, those three risks are probably going to be mentioned very prominently. And then the two tools that we use now are net income simulations and net economic value. The net income simulation measures the income statement. Net economic value measures the balance sheet. Okay, so just some of the things to think about from a high level. Now we're going to get into the two reports themselves. So the first one is a net income simulation. So when we think about net income simulations, when do a lot of credit unions run them? They run them when the examiners come in. Okay, and there's nothing wrong with that. But I would encourage you as you move up the organizational chart of your credit union, if we're going to run these, if we're going to do anything for the examiners, let's make sure that we're doing it on a regular basis ourselves, so that way we can begin to understand what are the numbers and what are the numbers telling us, and then just like we did in the ratios project, dive into the why. Why does the net income change when interest rates go up or go down? So that way, when we have to explain it to the examiners, whether they're federal or state, doesn't matter, then I have an idea as to what's going on because we look at it on a regular basis. We can also do what if scenarios. So what if we were to increase deposit rates rapidly? How would that impact the bottom line? How much could we increase those rates before we would have a negative net income number? So we can do different what if scenarios as we're going along. So when we take a step back on a net income simulation, before we even get to the output, let's just think about accounts, different types of accounts, different types of instruments, and how they're going to change. So when you have accounts that don't have defined maturities, so think of regular shares as an example, or a money market account. As soon as you move the rate on those deposit accounts, when do the members get the new rate? Immediately. Okay. Now, maybe we move the rates differently on a regular share account compared to a money market account or a share draft account. But as soon as I move it up or down, that's an immediate effect. So accounts that don't have defined maturities, they're going to get the immediate increase or decrease in the rates. On the asset side, examples of accounts that don't have defined maturities would be your overnight account at the corporate credit union. It could also be things like credit cards. So as soon as you move the rates, because credit cards are variable rate, as soon as that rate moves, everybody's going to get the new rate. Okay, so think in terms of that for the instruments. But then what about accounts that have a fixed term to them? So on the deposit side, think about certificates of deposit. When would a member get a new rate on a CD? The answer, when the CD matures. When the CD that they currently have either matures or they break it early. But either way, they're gonna get the new rate when they get a new CD. Okay, now we come up to the asset side and we start thinking about loans. When do our members get new loan rates? If I decrease my car loan rates by 25 basis points, when are the members going to get those new rates? The answer, when they get a new loan, right? Because if it's a fixed rate loan, which a majority of loans that we make in the credit union industry are car loans, personal loans, mortgage loans, all those are fixed rate by nature, then it's going to be a new loan. Now, the new loan could be that a member refinances their existing loan to a lower rate. So that could be how they get it. But again, that's a new loan. So always be thinking in those terms from a high level perspective. Keep in mind that there's two different types of rates environments. The examiners like us to run immediate and permanent rate shocks. So think about 300 basis points or 3% immediately goes up and permanently stays there. Okay, so that's an immediate and permanent rate shock. There's nothing wrong with looking at immediate and permanent rate shocks, but for us in credit unions, the more realistic example is a gradual rate shock. So that's where the model will bring in the increase in interest rates over a period of time. And when I say increasing interest rates, keep in mind that what I'm describing is external interest rates move up or down. And that influences us to do something. And why does that influence us to do something? Because it's influenced our members' behavior. So if I have a 6% 30-year fixed rate mortgage on the books, and all of a sudden mortgage rates go down to 3%, what am I going to have to do with my mortgage rates? I'm going to have to lower them, because one way or another, that member is going to refinance that mortgage, right? So the question simply becomes, are they going to refinance it with me, or are they going to refinance it with somebody else? Okay, so when those external interest rates change, because that's what we're really talking about, that influences us to do something. And so that's what those rate shocks do. Now, I could see gradual shocks come in over a 12-month time period. Maybe it's longer, maybe it's shorter, but that tends to be the more realistic scenario of what happens. So here's the bottom part of a net income simulation. So when you see this, so the flat rate environment, that's a 0 basis point environment. So think of your budget. Here's the budget for Tim Gardner Federal Credit. Okay, interest rates aren't going to change. We think our net income is going to be $1,236,000. So then that translates into an ROA, 72 basis points. Okay, so now we take our budget, our forecast, because that's in an ALM system, that's what we're always modifying. We're always modifying the forecast. Same thing that we do with a budget. It's just that a forecast is always for a rolling 12-month time period, whereas a budget is static for whatever the calendar years that we're looking at. Okay, so I got my forecast in there. Now, external interest rates go up by 3%. What does that do to my bottom line? Well, I can see that net income is going to go down. So just from a high level, and again, just like we did in our time together in year one, I want you to understand the concepts more than I want you to understand, delving into the numbers of a report that doesn't mean anything. Okay, so the concept, when interest rates go up, I mean, we can assume that we're going to increase our loan rates. Okay, so that makes sense. But again, then we take a step back to which loans are going to get the new rates. The answer, the new loans that we're making, not the existing loans. And so it's going to take me a while to see that increase in loan income, because I'm operating in a rising rate environment. Now that's on the asset side. So then we come down to the deposit side. When we're operating in a rising rate environment and we increase deposit rates on shares, share drafts, and money markets, that takes effect immediately. So in a rising rate environment, I'm going to see an increase in my cost of funds when I'm paying on my deposits. That's going to be a whole lot faster than what I can turn around and offset that with for an increase in loan income. So in a rising rate environment, we can see a lot of times that our net income is going to go down. Okay, and it's going to go down because the cost of funds is going to increase faster. Now, over time, if we're looking 2 years into the forecast, I could see my cost of funds increasing and then plateauing out. but I would increase my yield on assets continuously as I make new loans at a higher rate. Okay. But then I come back to the decreasing rate environment. So I know what you're thinking. You're sitting there thinking, well, Gardner, this can't be right because it should be symmetrical. It should be that if my net income goes down when rates go up, then when rates go down, my net income should go up. Okay, so clearly there's something wrong with the model. But again, we take a step back and we think about your yield on assets compared to your cost of funds. You don't even have to remember what the actual numbers were. If you were going to tell me which one of those two ratios, yield on assets or cost of funds, was higher for your credit union, which one would it be? Yeah, it was the yield on assets. Okay, so rates come down. So even if I took my cost of funds, even if I took my cost of funds all the way to zero, that's going to be a decrease for most credit unions. That's going to be a decrease of somewhere around 30 to 50 basis points, right? That's what our average cost is. So let's say it's 35 basis points. So cost of funds, even if it goes to zero, that's a decrease in the expenditure of 35 basis points. Now, take a step back and think about that yield on assets, right? Where's the yield on assets for most of us in credit unions? What, 3.5, right? Maybe 4, something like that. Whatever it is, it's going to fall a lot further, or has the potential to fall a lot further than the 35 basis points that my cost of funds did when it hit zero. And so because there's a chance that there's a bigger decrease in the yield on assets, that's what's going to give me the potential for a decrease on net income in a decreasing rate environment. So again, we just want to be able to think in terms of the instruments that we have on our balance sheet and how they might impact our bottom line. Again, in a decreasing rate environment, maybe my loan balances, as an example, don't change. But if all the members are refinancing their loans to a lower rate, well, that's less income to me, which means that my yield on assets is going to go down. Even though, again, I might be able to keep the same amount of loans on my books. So the net income simulation is what we use to evaluate the income statement. Okay. Then we get into the tool that we use to evaluate the balance sheet, net economic value. And when we get into net economic value, this comes back to what's the market value of the institution. And when we hear market value, what I want you to think about is if we were going to take all the loans that we had and all the investments and we were going to sell them into the market, how much money would we get? Would we break even? Would we get, would we have a gain? Would we have a loss? Whatever the case may be. Because whether somebody's going to give me 100 pennies on the dollar or somebody's going to give me 90 cents on the dollar, the reason that's going to be determined, the mechanism that's going to be determined by is what can somebody get in the marketplace right now. If I want to try to sell a car loan to somebody, and my car loan, my instrument, let's say that, my instrument has a 4% rate on it. But everybody else in the marketplace is getting 5%. Well, nobody's going to give me 100 pennies on the dollar, right? Because they could get 5% somewhere else. And so that's the market value. That's how we determine market value on the asset side. So market value comes back to cash flows. Got to have good cash flows to evaluate the risk in my balance sheet. Then when we come down to the liability side, the deposit side, the way that we evaluate the market value of the credit union's deposits is we have borrowed money from the members, and that's what is referred to as deposits. We've borrowed money. Usually it's at a lower rate than what it would be if we were going to go out and borrow money from the wholesale marketplace. So if I was going to go borrow money from my corporate credit union or from the Federal Home Loan Bank, chances are I'm going to pay a lot more for that borrowing than I am for borrowing from the members. And so inside of an NEV model, the market value of deposits is determined by comparing what are we paying to the members to what would we pay if we were going to go out and borrow the same amount of money in deposits. So if I've got 200 million in member deposits on my balance sheet, if I was going to go out and borrow 200 million from my corporate credit union, what would that look like? Okay, so that's how the asset side, the liability side, when we talk about market value, that's what it comes back to. And then when we take the difference between those two, so in a rising rate environment, the value of the assets declines. In a rising rate environment, the value of the deposits would show a nice increase because, again, we're getting the money cheaper from the members. And so the difference between those two would be the market value of my equity, the market value of my capital, the market value of my net worth. And that, ladies and gentlemen, is what is called net economic value, NEV. So it's going to evaluate the risk that I have in my balance sheet. So like I mentioned, it's all about cash flows, cash flows, cash flows. I got to have good cash flows. There's a couple of different things that I'm going to use to help determine the cash flows on the loan side and on the investment side. If I have amortizing investments, I'm going to use prepayment tables that are going to simulate what would the prepayments look like as those external interest rates change. On the deposit side, on the non-maturing deposits, the NMDs, I'm going to use decay tables. Decay tables is where it takes deposits that don't have stated maturities and it makes them look like they're going to be around for a stated period of time, 3 years, 4 years, 5 years, what we call the average life of that. And those cash flows on the asset side and the liability side, those are going to change when interest rates go up or go down. When interest rates, think about a loan. When interest rates come down, how does that influence a loan? It's going to influence the people to refinance the loan, so the cash flows might speed up a lot more than they would when interest rates go up. Okay, so those changing cash flows, that's what shows the volatility in an NEV report. And like we talked about, fixed rate loans, fixed rate investments, that tends to be the majority of what we buy in credit unions. If you have a variable rate product, like credit cards, HELOCs, maybe a variable rate investment, you're not going to show as much interest rate risk because the rate's just going to change with whatever the market rates are. Okay, so there's not as much interest rate risk in variable rate products. The interest rate risk comes in the form of fixed rate products because the rates, the coupon's fixed, but the external interest rates are changing. Okay, so the coupon rates are held constant. We compare that to the external rates, the market rates, discount rates, if that's how you want to think about them. And then how do those changing interest rates influence the cash flows that are in the balance sheet? So here's what an NEV report can look like. For the PreWork, I don't necessarily want you to go through every single line item on here, but we can see some. I'll go through some of the lingo, some of the column headers, if you will. So do you see the column that says book value? Book value is what's on our books. That's what's in our general ledgers. That's what our actual balance sheet is. And then we can see for 2 columns over from that, what's the base market value? Okay, so how does the market value change over time? And then the column right next to that, how does the market value change when interest rates go up? So let's just take car loans, for example, so new and used vehicles. So So I got 102,428,000 on my books. That's my book value. Then in the market value column, the loans would be worth $102,449,000. So what does that tell me? That gives me a pretty good indication that we're probably priced right at, maybe slightly above where the market is for our car loans. That's the base market value. Now, if interest rates go up 300 basis points, the value of those car loans goes down to $98,372. Why does it do that? Because car loans are fixed rate. So if I was going to try to sell my portfolio of 102 million, nobody's going to give me 102 million because external interest rates have gone up by 3%, which means they're originating car loans that are 3% higher than what they were when I originated the ones that I did on my balance sheet. So that creates the market value goes down. So that's a decrease of $4,077 in the value of my car loans. So that creates a decrease in the value. Well, the same thing happens with real estate loans. Now, my real estate loan portfolio is smaller, but when you come over here and you look at the percentage change, so you can see that the real estate loans, the percentage change, I mean, yes, the actual dollar amount is less. It's $2,371. So the actual dollar amount is less, but the percentage change is actually bigger. The percentage change between the base and then that plus 300 basis point environment. So there's more volatility. Why? Because the cash flows are longer. So the longer the cash flows, the more volatility that is going to show up in an NEV report, which is why when you look at this particular credit union, they have total investments. You can see that they have a larger investment portfolio than their consumer loans, car loans. So it's a pretty substantial amount of their assets. So when interest rates go up, the value of their investments goes down. It goes from $108,833 down to $94,083. So that's a change of 13.55%. So that right there, when you see the change in real estate loans is 10%, and the change in the investment portfolio is 13.5%, that would be a really good indication that this credit union is probably, they have probably bought investments that are backed by real estate loans. Okay. So they probably have a lot of real estate products, real estate backed investments in their investment portfolio. So interest rates go up, the value of the assets goes down. So it goes from $267,543 right here in the base column, total assets. They go down to $246,029. That's a decrease of $21,514 or 8% decrease in my assets. Now, I can offset that, some of it anyway. I can offset some of that by gaining value from the deposits, because if interest rates go up by 3%, the members of my credit union are not going to require me to increase all of my deposits by 3%. Why? Because factored into the rates is also the fact that, a lot of our members that have shares and share drafts particularly, they like the services that we offer. So they might not necessarily require me to increase my rates at all on shares and share drafts. Money markets and CDs, I would have to increase, but I can hold down as the external interest rates rise. I can hold down what I'm paying on my cost of funds. And so that creates value. There's more value by borrowing from the members because they aren't going to require me to increase all the rates to whatever the market rates are. So, I can see on the liability side. Now, the way we do this, so liabilities are opposite from assets. Okay. So when you see a decrease in the value of assets, that's a bad thing. When you see a decrease in the value of liabilities, that means you're picking up value. When we compare what we pay to the members to what we would have to pay, if we were going to go borrow money from the secondary marketplace, we pick up value. So assets go down by 8.04%. We pick up 4.76% by borrowing from the members. So the difference between that is, the decrease in my equity. It's still, it still is fairly substantial, but it's the fact that I was able to offset some of that decrease in the assets by picking up value by borrowing from the members. And so net economic value shows me how much volatility do I have in my balance sheet. If I have longer term cash flows, okay, on the asset side than I do on the liability side. So another way to think about it is at your credit union, when somebody opens up a share account, regular share account, how long does the account typically stay around, stay open? If you could say that for us at our credit union, they tend to stick around 7 years. So a regular share account tends to be around 7 years. That's the average life of the funding source. Well, then the average life of a 30-year fixed rate mortgage is also 7 years. So I've got a really good match on my funding source compared to the asset. What we tend to see is if the average life of the asset is 7 years, the average life of the liability, the deposit, probably going to be something like 4 or 5 years. So there's a mismatch there. And so because there's a mismatch, that's what creates volatility inside of the balance sheet. And that's what NEV helps us understand. How does the length of the cash flows change on the asset and on the liability side as we're going along? Okay. And how does that change over time? The more of a mismatch I have, the more volatility is going to show up, and those sorts of things. So, we're going to cover this a lot more in class, but I did want to introduce some of these concepts, especially for the pre-work since it's recorded, and then you can watch this multiple times. You can pull out your NEV report for your credit union, maybe try to ascertain what some of those numbers are. We did talk about spread report. Again, for me, spread report's a great place to start, especially after calculating all those ratios, like y'all did for the ratio section of the project. So spread report is probably going to feel right at home, but it gives us the sense to see, it gives us the ability to see if we want to change ROA, what are some of the different levers that we can do to make that happen. Net income simulations is what we use to evaluate the risk in the income statement or the risk to the income statement. So what's going to be the change on the bottom line when interest rates go up and go down? And again, always take that step back to say, well, whatever the instrument is, how soon could the interest rate change? Whether the interest rate is 100 basis points or 10 basis points, how soon could a member get that new rate? Okay, so always think about it in terms of that. And then net economic value is the change in cash flows in our balance sheet. So NEV is what we use to evaluate the risk in the balance sheet, and that's important to us because the largest amount of income that we have comes from the balance sheet. The largest expense that we have comes from the income statement. That's operating expenses. That's compensation and benefits. Okay, so that's why using those two different tools can help us understand how changing interest rates can impact us. On a net income simulation, it definitely helps us understand the impact to the bottom line because operating expenses are basically fixed for us in credit unions. They don't fluctuate a whole lot. So therefore, if we got a big fixed expense on the income statement, well, the balance sheet's what throws off the most income from loans and investments. So how could that be impacted by changing interest rates? And that's how, when we get together, that's how we're going to try to bring the concept of asset liability management together for us, and something that can start to make sense. Because again, the more you want to increase or go up an organizational chart, the more you want to increase your knowledge about numbers and risks, asset liability management is how we have to do that. So that's the primary tool. That's why in year one, it was all about the ratios, understanding balance sheet and income statement structures. And then in year two, we start to get into the concept of how to manage risk. Okay, so you guys got my email. You got my cell phone on the first slide. If you got any questions between now and the time that we connect in Athens, let me know. Thanks a lot. Have a good day.